Good afternoon, everyone. Thank you for joining early, as a matter of fact, for this month's webinar. If you can take the opportunity to go ahead to the handout section of the webinar and grab the handouts, grab the resources we have there for you, and we will promptly begin at the top of the hour. So, in about 3 more minutes, we want to be respectful of your time. So, with that being said, we will certainly join or start the webinar at the top of the hour. Again, thank you all for taking the opportunity to join us this month. And I wanted to also add for some of you that may be new to the Consolidated Credits monthly webinar, this is an informational webinar only. It is not interactive with questions and polls or what have you. It's only us providing information. So there is not a segment for question and answers. That is why we provide the resources, the different handouts for you. However, you will be provided an email after the presentation. Should you have any questions, comments, or concerns, you can go ahead and email us, and we will most definitely look into your concerns. Okay, so I just wanted to put that out there because there was a concern about, hey, I wasn't able to ask my question. And that is because this is not an interactive webinar, it's for informational purposes only. But again, I will say if you have questions or concerns or anything regarding the webinar, you will have that email address whereby you can send your question and we will most definitely get back to you with the answer. So we're going to give a few more minutes. I have 1 minute till the top of the hour. I use top of the hour because you could be in different time zones since this does goes out nationally. So I have 1 minute until our start time. And thank you all for coming in early, for being on time. We will be respectful of your time, as I forestated, and we will begin the webinar promptly at the top of the hour, maybe 1 minute past. Okay. So I'll be right back with you. Thanks again for joining. Good afternoon, everyone, and thank you for joining us for Consolidated Credit's monthly webinar. Give yourself some credit without adding any debt. You can raise your credit score, hike your credit limit, and still save money. Well, welcome again. Today, we're going to talk about the most mysterious number in your life. Nearly everyone has heard about credit scores, thanks to commercials and ads from the likes of Credit Karma. And even your banks and credit unions or your credit cards offer you a free peek at your credit score these days. But how do they really work? And even more importantly, do you know how to use those rules to boost your score? Well, That's what we're going to talk about today. Headquartered in Fort Lauderdale, our mission is to assist families throughout the United States in ending financial crisis and solving money management problems through education and professional counseling. Before we talk about what a credit score is, let's talk about credit and what credit is. I know it sounds so obvious, doesn't it? But it's worth a refresher. Anytime a bank, finance company, or business lends you money and you agree to pay it back at a later date, you're using credit. Almost always, you pay for the privilege of borrowing this money, either in the form of fees or interest or both. Your credit score is a three-digit number ranging from 300 to 850 that's used by lenders to estimate the likelihood of you repaying what you borrow. There are five factors that comprise your credit score. Any one of these can raise or lower your score depending on how you handle them. But here's the thing, they're not all created equal. Two of them are actually three times more important than the other two. If that sounds rather confusing, let me explain that. This is actually the biggest chunk of your credit score. It represents more than a third of your overall score. So, why is payment or what is payment history? Simply put, it's how often you pay your bills on time versus how often you pay them late. If you're wondering why payment history is such a big deal, think about it from a lender's perspective. They use your credit score to decide if you're reliable. Now, if you are, they'll charge you a lower interest rate. But if you can't pay your bills on time, that means they don't get their money back. So the worse your payment history, the higher your interest rate. This is why bankruptcies, foreclosures, repossessions, charge offs, collections, and tax liens can crater a credit score very fast. It is also why it can take so long for your score to recover. The next biggest chunk of your credit score is equally simple. How much debt do you have? In a minute, we'll talk about tips for raising your credit score quickly, and it will involve this category. But first, we need to learn about something called credit utilization ratio. This is a fancy term for a very simple concept. How much of your available credit you use at any given time. To figure out your credit utilization ratio, just divide your total credit card balances by your total credit card limits. The resulting percentage is what lenders use to decide if you're a good credit risk and whether you get a good interest rate. Most experts agree that you want your overall credit utilization to be lower than 30%. That tells lenders, hey, I can use credit responsibly without leaning too much on it. So, as you can see, just two factors are responsible for nearly two-thirds of your credit score. Let that sink in for a moment. While everyone is bombarding you with life hacks for boosting your credit score, paying on time, and lowering your credit utilization ratio are the quickest and easiest ways to do that. Now, let's look at the other factors that comprise your credit score. But never forget this number. Never forget 65%. From here on, the percentages drop. At a measly 15% is your credit history, specifically the age of your credit history. Up till now, we've talked about paying bills on time and how much you owe. Now we're talking about how long you've had your credit accounts. How many years have you been paying your mortgages? How many months have you had that credit card? Generally speaking, the longer you've had your accounts, the more lenders like you. Why? Because it shows you have experience managing credit as well as debt. That means you might be savvier about handling a new line of credit. In a few minutes, we'll talk briefly about how you can use this knowledge to boost your credit score. Now we're down to the smallest slices of your credit score. Think of new credit as the opposite of credit history. This category refers to credit inquiries or hard pulls, which happen anytime you apply for any type of credit. These hurt your credit score rather than help it. With few exceptions, and we'll talk about those in just a bit. You don't want to add too much new credit. In other words, you don't want to suddenly sign up for half a dozen credit cards. When lenders see that, they get really nervous. Say you just got a new credit card, then you took out a new auto loan and get another student loan. If I'm a lender, I'm thinking, hey, now if this person wants to borrow my money, how will I get paid back if they also all owe all these people? While it's only a small piece of your credit score pie, it's still worth keeping this in mind. Last and almost least is type of credit. This is also called credit mix. Lenders not only like to know how long you've had your credit accounts, they want to see some diversity. There are four different kinds of credit, which we'll cover in a second or two. Well, everything else being equal, lenders want to see you deftly juggling all four. You're less of a credit risk because you've seen it all. And if you have a long history of these accounts, you've also done it all. Basically, what we're trying to do here is put you in the head of a lender so you can understand how they make their decisions to give out money. Once you grasp that, then it's a short step to using that knowledge to raise your credit score. Let's talk about that right now. Of course, when it comes to money, nothing is simple. Credit is no different. There are four kinds of credit. You're probably familiar with them all, even if you don't recognize the names for them. So let's quickly go over them. First, revolving credit. Here's what that is. You're given a credit limit. You can borrow money up to that limit, and each month you can pay it off or carry it forward. Basically, it revolves in exchange for paying interest, of course. Does this sound like your credit card? Because it is. Next up are charge cards, which are not credit cards. These cards are just like credit cards, except you must pay them off every month. American Express is the best known charge card, but there are many others. Third on the list is something called service credit. You essentially sign a contract for services that you promise to pay each month. You do this with your utilities, your cell phone, and your gym membership. Same with all those streaming services you have as well. Lastly, there's installment credit. In this category, a lender gives you a chunk of money upfront and you promise to pay it back with interest, but in fixed amounts over many months. Think of your auto loan or mortgage. They're both examples of installment credit. They're mostly reserved for your biggest purchases. Now, you don't need to memorize any of these, but it's helpful to keep in mind. Why, you may ask? Because your credit score depends on who keeps track of the credit you have and what you do with it. For instance, not all service credit counts towards your credit score. So let's talk about what does go into your credit score. So, one of the easiest ways to boost your credit score is to make sure nothing is dragging it down. You'd be surprised how many credit scores are suffering for reasons that have nothing to do with their owners. We're talking about mistakes on your credit report, mistakes you had absolutely nothing to do with. First thing to know here, a credit report is not your credit score. It's the raw data that determines your credit score. You know, those big three credit bureaus that we talk about, they each have a credit report on you with a whole heck of a lot of information about you. With nearly 330 million adults in this country, times three credit bureaus, that's a lot of credit reports and a lot of room for error. The federal government estimated 5% of those reports have serious mistakes in them. And that was from back in 2013. It's likely gotten worse since then. Those mistakes can range from saying you defaulted on a loan when you didn't, or you were late paying a bill that wasn't even yours. Maybe someone has the same name as you and a computer glitch assigned that person's debt to you. Maybe it's a clerical error, or maybe it's just simply unexplainable, but it happened. Now, what do you do? You need to scour your credit reports for mistakes. Luckily, federal law makes that free and easy to do. Those big three credit bureaus are required to give you a copy of your credit report once a year and at no charge. Best of all, you don't have to go hunting them down. You go to one official website, annualcreditreport.com. In fact, here's what the pros do. They request only one credit report at a time. So, say in April, they fetch their report from Equifax. Then, 4 months later in August, they get their Experian report. Then, finally, in December, they get their TransUnion credit report. Then, they check them to make sure everything they see belongs to them. Why do it this way? Because if they check every 4 months, they can protest a mistake much quicker and get it removed. That's right. You can force those big three credit bureaus to fix mistakes. And here's how it's done. A federal law called the Fair Credit Reporting Act gives you the legal right to easily contest anything that you think is wrong on your credit report. Each credit bureau lets you dispute charges online and they must investigate. To learn more about this process, you can contact us and we'll give you that info at the end of the presentation. But the important thing to remember here is this: an accurate credit report can boost your credit score because mistakes are anchors that drag it down. Now, before we talk about what you can do to boost your credit score, let's talk about raising that number without lifting a finger. First, don't apply for more lines of credit. These include credit cards and loans. Every time you do that, it creates what's known as a hard pull on your credit report. Lenders know that lots of hard pulls means you're shopping around for more credit, which means you might not be able to afford paying back what you borrowed. That lowers your credit score, albeit by only a few points, though. But some people load up on credit cards, and the cumulative effect is not good. And who needs all those cards anyway? If you can't keep track and miss a payment, then your score really takes a hit. At the same time, if you have credit cards you're not using regularly, don't close them out. Why? Because as long as they're not costing you money in annual fees, their mere presence helps your credit utilization ratio. Remember, your credit utilization is about how much you're spending against your credit limits. Those cards add to your limit, even though you never pull them out of your wallet. And if you've had these cards for a while, they also add to your credit age. Let's talk briefly about credit card protection plans and cash advances. Strictly speaking, neither of these things directly affect your credit score, but they're bad news for so many people, and they indirectly can trash a credit score. Let me explain. Credit card protection plans are a kind of insurance. They're advertised as giving you a break on making payments if you suffer, say, a financial hardship. You can pay up to $1 per $100 charged for this protection. But in our own clients, we found this adds up to a lot of money per year for benefits that's not as easy to claim as you might think. There's a lot of rules, fine print, and red tape. Meanwhile, your money is going to this plan instead of going towards paying down your balances. Likewise, cash advances aren't part of your credit score, but they come with steep fees that can get you behind on all your bills. Just avoiding these two costs can spare you big bills and big headaches later on. Some credit score myths arise from a simple truth that gets stretched into a ridiculous theory. Let's look at two we hear a lot. First, your job title and income have no direct effect on your credit score. Those big three credit bureaus care only about how you pay for what you spend. In fact, we've worked with plenty of six-figure income Americans who are deeply in debt and have a terrible credit score. So your prestigious job and hefty paycheck just don't matter when it comes to credit scores. So where did this myth come from? Probably the fact that a higher income makes it easier to make lifestyle changes that can pay down debts faster and thereby boost your score. Also, when you apply for credit, lenders will probably ask about your income because that matters to them, sometimes as much as your credit score. Likewise, getting married doesn't help your credit score. There's a myth that once you get married, you have a joint credit score, kind of like you might get a joint bank account or have both your names on a mortgage. Not true with credit scores. In fact, those joint items will appear on both of your credit reports and they'll affect both of your scores for good or ill. But your credit report is yours and yours alone. This myth probably got started because there are many studies that show married couples have higher credit scores than single people. The reasons are quite clear. You share a home and incomes, and if one spouse is a spendthrift, the other might be able to rein them in. But marriage itself doesn't directly affect your credit score. Finally, here's the surefire advice we know works: consult a professional. Consolidated Credit has certified credit counselors who will offer a free debt analysis. Once you know exactly where you stand with your income and debts, you can manage your money in ways that will send your credit score into the stratosphere. And if your debts are dragging down that score, those counselors can explain your options from do it yourself to government approved programs. It's a simple and it's a free phone call. If you have any questions or you want more free advice, we're here for you. We simply invite you to go to consolidatedcredit.com. You can call the number that's on your screen as well. We'd like to take this opportunity to thank you so much for joining us for today's webinar, and we look forward to you joining us for future webinars. I want to give all those that did not have the opportunity to go ahead to the handout section of the webinar and grab your resources, grab the things that we have there for you. You can either download them or you can print them, whichever your preference, whichever your preference. I stated before the webinar started that this is not an interactive, this is purely informational webinars. If you should have any questions, please feel free. You will get a follow-up email. You can go ahead and respond to that follow-up email, or you can email us at what is that website? Just wait for the follow-up email, okay? And you can always send us the email with any of your questions, and we'll be happy to respond to any questions you may have. Thank you all again for attending. We hope that you found this information to be beneficial. Please visit us at consolidatedcredit.com or really .org. Thank you, consolidatedcredit.org. That is our mistake there. Or you can call us on the number on the screen, 800-210-3481. May the rest of your day be the best of your day. Again, thank you so much for joining, and we look forward to you joining us for future webinars. Take care, everyone, and be safe.